What's up guys, Ali here, and today we're going to be talking about different mortgage term lengths, which when I say out loud sounds extremely boring, but I promise you the information in this video can save you hundreds a month and potentially even actually make you hundreds of thousands in the process. So by sticking around to the end, you're going to find out all the pros and cons of a longer term versus a shorter term, get a clearer idea as to which option is going to be best for you and your personal goals, along with how to actually maximise the benefits from your mortgage, and most importantly, how you can save all that glorious money and maybe even make some in the process. But before we get started, I'd really appreciate it if you hit that like button down below, and also comment where you found this video, as I'm generally really interested to know. But with that said, let's jump straight into it by covering off the basics first. So, your mortgage term is going to determine how much your monthly payments are going to be, along with how fast you're going to repay the loan itself. It won't have an impact on the different interest rates available to you, so by picking a shorter term, you're not going to have access to cheaper rates than compared to whether you took a longer term. But the term length can actually have an impact on your affordability for the loan. And what I mean by that is that if you were to take a crazy short term, say 10 years, then obviously your monthly payments are going to be crazy high as well, to the point where those monthly payments probably exceed your monthly income. And the maximum term you can pick for your mortgage is going to be capped by two factors: either your age or just generally the longest term a lender's willing to offer you. Now, in regards to age, the mortgage actually has to be paid off before you retire. Now, this is typically going to be at age 65 or 70. And in terms of the maximum term a lender's going to offer you, it's going to be either 35 and sometimes even at a push 40. So whatever is lower out of these two is going to be your cap. Moving on to the pros and cons between a shorter term versus a longer one. Now, with a 25-year term, you're obviously going to pay this off in 25 years compared to a 35-year term where, you guessed it, you're going to pay that off in 35 years time. So over here, you're going to own your home outright a lot quicker with less overall interest paid to the lender because you're having the mortgage for a relatively short period of time. But the main con that comes with this is that your monthly payments are going to be a lot higher. Whereas over here, the pros and cons are basically just the opposite, as you'll pay more interest to the lender and pay it off over a long period of time, but your monthly payments are going to be a lot lower. And if that didn't make sense, here's a quick example. So let's just say we have a loan size of £200,000 and with an interest rate of 4.7%. Now, the reason we're using an interest rate of 4.7% is because over the last 25 years, the Bank of England base rate has averaged around 3.7%. But because the actual mortgage you're going to get is never going to be exact to the base rate, I've added an extra 1% to give us a more realistic average. And the reason why we need to use an average is because although interest rates are at all-time lows right now, you're not obviously going to have an interest rate of 1.7% throughout the whole lifetime of your mortgage. So by using an average, it's going to give us a more accurate indicator as to what your total mortgage costs are going to be over the whole term. Sorry to get a little bit technical there, but basically we're just using a loan size of £200,000 with an interest rate of 4.7%. Now, over the 25-year term, your monthly payments are going to be around £1,130 a month. So your total out-of-pocket cost is going to be the original mortgage size, so that's £200,000, plus around £140,000 in interest. Whereas with the 35-year term, your monthly payments are going to be around £970 a month. So your total out-of-pocket cost at the end of the term is going to be the original mortgage amount again, so £200,000, but this time, your interest payments are going to be around £208,000. So £68,000 more than over here. And the reason why you pay so much less interest over here is because more of your monthly payment is going towards reducing the principal, which is basically just the outstanding debt. So you might be thinking that the 25-year term is the better option. I mean, you're going to own your home outright a lot quicker, and you're going to save yourself almost £68,000 worth of interest. But it's not. The 35-year term is the better option in most cases. And this is because of the flexible options attached to most mortgages in the UK. As most lenders are going to let you overpay by up to 10% of the mortgage debt each year without incurring any additional fees. This means with a £200,000 loan, you can obviously reduce it by £20,000 in the first year, and in the next year around £18,000 roughly speaking. Because of this, what you could do is take the 35-year term, but then set up a standing order to overpay the difference between the two terms. That way you would still pay your mortgage off in 25 years time, but should a financial emergency happen, you can just revert to paying back the lower amount over the 35-year term. And the reason why you're able to revert back to the lower monthly payment is because the monthly payment without any additional overpayments is the minimum the lender expects each month. So the minimum monthly payment over here is £1,130, and the minimum over here is £970 a month. Even if you don't want to make this overpayment, there is another factor which basically pays your mortgage off for you without you having to do anything, and that is inflation, which is basically just the cost of things getting slightly more expensive each year as money becomes less valuable each year. A real life example I think all of us Brits can relate to is when you used to be able to buy a Freddo for what, 10p? Now for that same teeny tiny chocolate bar, what does it cost now? Maybe 25p? So that's just a real life example of inflation. Well, the same thing happens with the value of properties, as they tend to rise in value greater than the rate of inflation, because inflation itself is a key factor as to why property rises on top of lots of other factors. And to take this one step further, when you actually take out a mortgage, you borrow the funds in today's value. And with a national inflation rate in the UK of around 3% each year, that technically means that your mortgage is getting cheaper by 3% each year, on top of it rising in value. So you have your mortgage debt getting less valuable each year, and the property you own becoming more valuable each year. This means that the longer your mortgage term is, the more you benefit from inflation. So another reason on top of the flexibility as to why the 35-year term might be the better option. Moving on to how you can actually make money by picking your mortgage term. Now, the easiest way to explain this is going to be by using an example. So let's just say that your monthly budget happens to be £1,130 a month. Well, then you can afford to take your mortgage out over the 25-year term and save yourself roughly £68,000 worth of interest payments. But there isn't a lot of value in making these payments because of the reasons that I mentioned about inflation, along with the fact that because interest rates today are so low, that any overpayments you do make, your savings are going to be relatively small in terms of interest savings. For example, today if you had an interest rate of 1.7% and you made an overpayment of £5,000 at the very start of the year, then your savings over the course of that year are only going to be around £85. And that saving becomes even smaller if you make that £5,000 overpayment over the course of the year. Instead, a better way to utilise your monthly budget would be to take the 35-year term and then invest the difference between the two, which in this case is going to be that £160 a month. This way, you're going to be maximising the benefits you receive from inflation, but also benefiting from potential higher returns in the stock market than that of the savings you would make from making the overpayments. Now, you might be thinking that investing is complicated and you would have no idea where to start. But there is an investment called the S&P 500. If you don't know what this is, it's basically just a collection of the 500 biggest traded companies in the US. Companies like Amazon, Google, Facebook, Apple, and loads of others that you may or may not have heard about. This means that by investing into the S&P 500, you're essentially spreading your money out across these 500 different companies. So your money is going to be really well diversified across really solid companies. And the average return of the S&P 500 over the last 100 years has been around 10%. But let's just call that 7% once we factor in inflation. So by taking the 35-year term, your monthly payments for the mortgage are going to be £970 a month, and then you'll be investing £160 a month into the S&P 500 for 35 years. And at the end of the 35 years, your investment pot is going to be valued at almost £290,000. And £223,000 of that amount is coming from interest, which is basically your returns on your investment, compared to the 25-year term where all of your budget is going towards the mortgage, but then at the end of the 25 years, you invest the full £1,130 into the S&P 500 for 10 years. Well, then your investment pot is going to be valued at around £196,000, with only £61,000 worth of that actually coming from the gains or the returns. So over here, you've invested £67,000 to achieve an investment pot worth £290,000. Whereas over here, you've invested £130,000 just to achieve £197,000. So that is why in most cases the 35-year option is better than the shorter 25-year term, as you still have the flexibility to pay your mortgage off in 25 years, but then revert back to the lower payment should a financial emergency happen, along with being able to maximise the benefits of inflation, with potentially being able to earn more in the stock market than the potential savings on the overpayments. But before I end, I just want to say there is no right or wrong answer to this. It's all about you and your personal goals. If you're someone that wants your mortgage paid off as soon as possible, but you know you're not disciplined enough to make those overpayments, then what you need to do is just basically pick a term which matches your monthly budget. But if you do want more flexibility and you want to take advantage of the benefits mentioned in this video, then you need to consider the longer term. I know there's a lot of information in this video, so if you do have any questions or anything didn't make sense, be sure to get down in the comments and I will get back to you. But if you did find that useful, I'd really appreciate it if you hit that like button and subscribe to the channel for more helpful personal finance and property videos. But with that said, thank you so much for watching, and until next time.